pretty much here, but still keep moving down. The reason for this is the market here did not make a new low, so this is still our valid low, and anything that happens between basically this level and these levels here is just consolidation. So this entire move becomes a consolidative move. So what we would do to approach this is mark our BOS line on around this high. We can just put it there just to keep it nice and simple. And then we would have a BOS line that we could mark out here. If the market was to push through this low, that would create a break of structure upon the push through, which would continue the bearish move. But what we did instead in this example was push to the upside, which at this level, where we start to close above the previous high, creates our first BOS. So the valid break of structure, or BOS, is this one here. There's no break here, so there is no BOS there. From that point onwards, we created a new high. We then came down, created a new low, and we pushed up to this point, which created, once again, a new high. So at that point, we see a clear BOS. We see our high printed there. We can drag that across, and you can see the structure, being this high, has broken into a new high. Okay, so that's going to be our next BOS. Now at this point, our valid low is this level. So we've got two opportunities from pretty much this point onwards in price action. Either, number one, we create a new low, push higher, indicating a break of structure and continuation of the uptrend. Obviously, you can see that is what happened. But the alternative would have been if the market had pushed down, crossing through this level would have created a BOS here, and that would have indicated further downside or the start of potentially a downtrend, which could push us into bearish impulses. Okay. Now, obviously, as you can see with the benefit of hindsight here, this market pushed into a new high, creating a break of structure at this level here as the market pushed its way into a new high. So what this does again is now creates our valid low. This is our higher low. We know that because the market's gone and closed higher. So this would be our BOS point, right? If the market was able to push through this level, that would indicate a downward trend. What we see happened is we pushed up, we pushed down, we stopped there, we pushed up and created a new high. So what we've got now is a new higher low, which we can pretty much put in around this point just here. So from this point up to here, that's going to be our break of structure at this level. And now, again, we've created two levels to work with. Either we push up, pull back, and then push up again, creating a new high, or we come and push down and break through this low, which would indicate a downtrend beginning, okay? So from where we are, which is here, we now see the market's pushed up. It did come down to break through this low, but it only broke with a wick, and we're going to get into this very soon. I want to just briefly mention it now, but if you see a wick like this, we don't really use this as a valid closure or a valid change in the trend. Now, a wick, the little sticks coming off the candles, what that indicates is rejection of price action. It's the candle bodies or the big blue and grey blocks that you're seeing that indicate confirmation. So if we wick under a level like this, that's not necessarily telling us that this market is going to be moving to the downside immediately. Sure, the fact the market got down here could be indication that maybe the trend changes soon, but it's not really going to validate a change in the trend until we see confirmation with closures. So following this push lower, we then have a push higher, which pushes us over our previous high. However, once again, these are just wicks. So pretty much from this low all the way up to this high, we now have a little phase of kind of no man's land where we haven't closed above, we haven't closed below. What we've just done is create a wick beneath and a wick above. So that actually puts this bit of phase of price action from here through to here into what we call a consolidation. And until the market made a closure one way or the other, we wouldn't have validation as to whether the market is going to continue moving up or whether it's going to start moving down. Now at this point, obviously, here, we created a break and close, and that went underneath our previous low. So, just clean this up a little bit. Our previous low that we had marked was pretty much these levels here. And as you can see, this push created closures beneath that level. So therefore, this would become our BOS, or break of structure, because we've seen closures underneath the level. And this is maybe first indication that the market is now moving in a downtrend, which, as we can see, is kind of what it's doing, because it's pushed us through to the next lows as well. So by marking the BOSs and marking the swing highs and lows and waiting for a break of structure either way, we basically get validation of whether a trend is going to continue going up, continue going down, or reverse to the other direction. Here we had our first break, which came in at this level here. That indicated an uptrend where we had bullish impulse, bearish correction, bullish impulse, bearish correction, bullish impulse, bearish correction, bullish impulse, bearish correction. Then we shifted into consolidation. The market did nothing, but eventually it broke through. What's this break? Well, this, considering it's now broken through a lower low, has become a bearish impulse. So now we could look for bullish correction, bearish impulse, and so on and so on and so on. That would be the first indication that this trend could potentially be changing direction. So that is how we plot BOS on the chart. And really, it's just for, number one, confirming trend directions. Number two, keeping our structure analysis pretty neat. As you can see, this compared to what we did before with drawing the impulses and drawing the HHHL structure on the chart, it was a bit of a mess. But this is very simple and easy to work with. We can see from this point onwards, if the structure breaks here, we go up. If it breaks here, we go down. If it breaks here, we go up. If it breaks here, we go down, etc., etc. And it gives us a clear way to understand which way the market is going and a clear way to react to the breaks in structure that we may see, whether they are up, pro-trend, or down, counter-trend, and the start of a new trend. So now we've taken you from no understanding of structure through to understanding impulses, corrections, how to determine uptrends and downtrends by using high and low price structure, and how to identify and indicate breaks of structure which will either continue moving the market higher or lower or indicate reversals as we see here. From this point, you've pretty much got everything you need to build the foundation of a profitable market structure trading strategy. Now we're going to talk about some traps and nuances and mistakes that people make before going on to showing you how to profitably trade using the structure theories we've discussed so far. So the first big mistake that a lot of traders make with structure is getting the internal structure wrong, right? Now, internal structure is anything that takes place inside of basically one of these impulsive moves. So our impulse in this example is from this low up to this high. Anything that takes place under this high and above this low is called internal structure. So the market can do whatever it wants. Unless it breaks out one side or the other, there is no real shift or no real urgency for us to start looking for positions. And any trades we do take are going to be kind of lower probability because they're not moving with the larger trend. Now, the mistake that people make in regards to internal structure is they will see a high forms and then we get a little low, which is internal. We get a new lower high, also internal. And then when the market breaks through this low, for example, traders will then see this here as a break of structure and a confirmation of this market going lower. So they will start looking for selling opportunities, thinking because the structure is broken here, we've actually seen a change in this upward trend. Now, you may already be able to see the problem with this, and that is because with it being internal structure, we still have a clearly intact uptrend. We had an impulse, we had a correction, we had an impulse, and now anything that happens here, whether it does all of this crazy price action on a lower time frame, is still just a corrective move. And the market can then still, and probably will still, go and push up in line with the larger uptrend. So if you start selling after an internal break here, let's say you sell from this high when the market pulls back, well, what can easily happen is that the market just pushes through into its next impulsive move and you end up getting killed on the sell because you've sold into a market that hasn't actually indicated a break in structure at all. Now, what we could see, which would make this better, would be if the market had pushed up like this and created a new higher high, okay, at this level, well, then that would have, number one, created a break of structure here, indicating a new impulsive move, which would then have created this price action of impulse, correction, impulse. And then if the market had pushed down through this low, that would be indeed a break of structure, which would be a bearish impulse. So we would be well within our right mind to sell from here on out because we will have actually seen a clear break of structure where bullish impulses are breaking into bearish impulses. But when you start to see the market like this and you treat this as a valid break in structure, well, now you've got a problem because this here is not a higher high. All it is a piece of internal structure that really doesn't tell us much of the story. And if you start selling into that, well, then when the market breaks up to make a new impulse, you're going to lose and you're going to be confused of why it happened. But hopefully not now that I've explained that. So making sure you don't get caught up in the internal structure and make sure you're only working off of the clear high-low structure of the market is a very simple way to avoid one of the biggest traps and biggest mistakes people make with structure. Right, now I want to show you that on a chart because I think this is going to resonate with a lot of people who have been into structure trading before or currently and are struggling. So if you take a look at this chart here, we've seen a break of structure which has taken place over the previous highs, this being the break, and this being what some people will see as a higher high. So seeing this price action on the chart, a lot of people are going to look for buys when the market pulls back. So they might look for the retracement with the expectation to then continue buying this because they see, well, this is broken structure, which has pushed us into an uptrend. Okay, you can see that there is on the surface a break of structure here over this high and over this high. Now, the problem with this is there is actually no clear break of structure here. Although it looks like there is, it's a bit of an illusion. Because if we look at the low that's been printed by price, which has taken place down here, we can now see that realistically everything that happens above this low is just internal structure. If we look at our impulsive move, it begins here and it runs all the way down to here. There is then nothing which has indicated a new break and change in the structure. So until we push over this high, there is no change in the trend. And all this is a corrective move that is likely to then follow through with a new impulse. So although it looks like when you look at this structure, we see, okay, we've had a break of structure, we're happy to start buying. Realistically, there is no reason to do that. In fact, if anything, you should continue selling because there's been no change in the structure other than this small kind of internal structure, meaningless pullback move. So if you were tricked by this, and I know a lot of traders are, this is one of the biggest problems with structure, then you're going to be drawn into buying when, in reality, what happens is the market just makes its next impulsive move and pushes into new lows. So what would have fixed this? Well, rather than creating our low and then just trending up like this, if we had instead created the low here, pulled back to these highs, then created a new low, and then pushed up above the structural highs, that would be a valid break because we'd have actually seen the impulses changing direction. But because we didn't get that, this is indeed still just a corrective move and is unlikely to lead into a large reversal, so therefore should be approached as just a correction to sell from into further bearish impulses. The next big mistake that people make with structure, and this one's a really easy fix, is failing to differentiate liquidity sweeps to breaks of structure. Now, a liquidity sweep, we're not going to go massively in depth on the topic of liquidity in this video, but there are many classes on my channel. But a liquidity sweep is basically where the market will push above or below a swing high or low, take out liquidity, which is essentially orders, and then reverse sharply in the opposite direction. As we can see when we look at, of course, the low we just drew on here and the high that we have up here. So we see a push beneath the swing low and then a sharp reversal. We see a push above the swing high and then a sharp reversal. So although on the surface these may look like breaks of structure because the market has pushed through this level, it's actually not. It's actually pretty much the opposite and is very likely to move against you. So the way you can differentiate between actual breaks of structure, which are going to lead into, new moves, and the liquidity sweeps that are going to lead into sharp reversals, which will kill you, is to look for closures above or below structure. So we can see at this low, we had no candle closure. And the candle closure, by the way, is simply when we see a large candle body like this close through a high or low. So if we look at this previous break of structure, we have a high, low, and then the break of structure which takes place here is a closure. We see a candle close higher than the previous high. That is going to indicate continuation of the trend. When we look at this potential reversal though, we actually see no closure under this low. We see a wick instead. Wicks indicate rejections or rejected and attempted price action. Bodies indicate confirmed and closed price action. So if we see the selling rejected at this level, what's that telling us? That's telling us buyers are too strong for sellers to get down there. So the next likely move is we go all the way back up and carry on in the uptrend. So by seeing a wick here, do not treat this as a break of structure. This is instead a liquidity sweep. The simple rule you can follow is if there is no candle closure above the level, don't buy. If there's no candle closure beneath the level, don't sell. Don't expect that to lead into a new trend. You have to see closures, such as we validated the breaks here when we started to see candle closures at this area over here, okay? That would be fine, but until we get a closure, as long as it's just wicks, treat it as either consolidation or no confirmation of reversal. So we can see again, after we pushed above this high, no closure, and then the market went for a sharp reversal. If we'd have seen a candle body close above this level, that would have then indicated that we can start buying pullbacks. But because we didn't get the closure, because we only got the wick, we see this as a sweep of liquidity or a sweep of the high and low instead of a closure and confirmation of continued trend. So make sure you're waiting for candle closures and not trusting wicks, because if you trust a wick as a break of structure, you're going to get killed a lot of the time. So we've discussed pretty much everything there is to talk about in regards to structure, and now we're going to learn how to trade it. And the most simplistic way to trade with market structure is by introducing a concept called supply and demand, okay? So what we have here is a diagram of an uptrending market. We have higher highs and higher lows. The market is impulsing to the upside, and then there are bearish corrective moves. Now, when the bearish corrective move bottoms out, we create here what we call a demand zone. The demand zone is basically an area where significant demand has come into a market, or in other words, where significant buying has taken place. Now, when we see a large impulse like this is driven by institutional buying, okay? The big push that breaks us into new highs is basically banks and trading firms placing significant orders, which is big enough essentially to drive the market, okay? The more people that want to buy, the higher prices go because the more sellers can demand for the asset. That's why they go high. So more people that want to buy is pretty much equivalent to the demand to buy. So another way of saying more people want to buy is saying there's high demand, okay? There's a lot of demand for buying this asset. When we see a corrective move bottom out, we then see what we call a demand zone a lot of the time, which is basically an area where the market has very temporarily gone sideways or consolidated before a large impulse to the upside. This tells us that this is a good place to buy. And basically the concept will then be, if this is seen as a good place, good price level to buy at, when the market returns to this level again, we are likely to see more buying taking place, okay? If there's a discount and then things get expensive, and then it comes back down to the discount and you want it, well, you're probably going to buy it down there. So that is what supply and demand is. Now, this is demand, the buy side. On the sell side, it works the exact same way, except what's happening here is the institutions are injecting significant amounts of supply into the market. So that is why we call it supply instead of demand. Obviously, this is then seen as a premium price to sell. If the market retraces to it and you want to sell your assets, well, the more you sell it for, number one, the more profit you make if you are in a buy trade. Number two, the better price you are in at if you are looking to short the market, okay? So that's the supply version. Let's focus on demand for the moment then. So what we often see within the market when we're looking at candlesticks is we have our demand zone, push away, and then the market pulls back, retests the demand zone, and then makes its next push away. Now, it's not always going to come back. Sometimes it's just going to come to there and then run away and you'll miss that trade. But it's the most simplistic and effective way to trade the trend using market structure by just looking to buy demand zones and sell supply zones. So in this example then, following on, we had a demand zone, impulse, correction, retest of demand zone. This is where we want to buy. Then following that point, we have had a demand zone, impulse. We would now look for a correction, and our demand zone is where we would want to buy again, okay? So we would essentially approach this market by buying this level, stop loss beneath the low of the zone, and then we can look to continue the market higher because we know with an uptrend intact, it's likely that we're going to get new highs once again, right? So that is the simple supply and demand way to trade. That's demand for uptrends. You only want to trade demand in uptrends, and you only want to trade supply in downtrends, okay? And this is simply going to be the same, but you're looking to sell the market instead of buy, all right? So this supply and this supply become good selling points. Right, let's take a look at this on a real chart. So we're doing a bit of replay and we're looking at NZD/JPY, 15-minute time frame, but for reference, this will work on any time frame you want to approach the market from. So at this point in time, we are looking at a downtrend. We've seen the market here create a high, then we've pushed into a lower low, then we've created a lower high, we've pushed again into a lower low, and a lower high, and now we've pushed lower once again. So we are now in a downtrending move, right? Just to draw that out for you, we have this kind of price action, and we are currently trading down here. Now we can see this downward move, this break of structure was created by a supply zone here. And to show you how I plot supply, I simply use the last candle before the impulse that has imbalance. So don't get confused, I'll break it down for you now. We see this candle here, this gray candle, this is the last candle before the impulse to the downside, okay? So that is why that will be the supply zone. Simply the last candle essentially before the push begins. So to show you a couple more examples, we would have this gray candle here. This is the last candle before an impulse to the downside that broke structure. Therefore, that is going to be the supply zone. As you can see, if you'd have sold that supply, you'd have caught a very nice entry to that move, okay? Now, the imbalance point I just made, an imbalance is simply an open candle range. So when we look at, for example, the supply zone we're currently focusing in on, we can see the wicks of these candles here go up to this point, but don't go into the supply zone, right? There is no wick filling this zone. So if this wick had traded in, that would have created efficiency or balance. Therefore, we wouldn't have any imbalance. Therefore, this supply wouldn't be of interest to us. But because there is still this open price range between these wicks and the wick of the supply zone, there is basically a draw. This is going to act as a magnet that pulls price towards that level. So this is therefore a level of interest. Now that is why we are not going to be interested in, for example, this, which is a last candle before an impulse. Why is that? Well, because this one has already been hit. So this could have provided its own trade, but we are kind of past that point now. There is no gap between this wick and the candle that we're looking at as our supply. Therefore, there's no real reason to focus on that level, okay? Again, here we have supply, but there is no imbalance. There was initially between this candle and this candle, but the market's filled this now. So there is no imbalance there for us to focus on, therefore making this one irrelevant as well. So the zone that we're looking at here is basically the last imbalance point in this leg of downward price action, right? Nowhere imbalance down here anymore. The only imbalance left is up at this point. So with this being the last candle before the impulse, and with it being an imbalanced supply zone, we know the market is trending down. We have that clearly mapped. Down, correction, impulse, correction, impulse. We would then want to look at this supply zone as our selling move, okay? So providing we don't push above the high around here, or even in this scenario around these points, we should remain bearish. Therefore, we could confidently sell this supply with stop losses above those highs and expect the market to at least come down towards this low again, right? So a simple way to approach is simply to target the low that's been printed in the market. Now, you can actually extend trades further because you're pro-trend trading. So if you wanted to and you expected the market to keep going, you could extend the target further. But for simplicity's sake, we're going to look at it like this and actually map just a target down into the low, all right? So generally then, what we would expect to see is for the market to return to the supply zone and then lead down in an impulsive move to create a new low, which would then open the doors to the next opportunity, right? Again, with this push down that we've now seen, we could look at the last candle before the impulse down. That's going to be up here for this example. So this would be where we would look to sell the market, all right? So if you were following this simple trend trading system, you would have your entry around this supply. Your target would go down into the swing low here, and then you would just look to sell that market when the market returns to it. Now, obviously, there are nuances. You can use confirmations and things like that, but we're keeping this lesson on track, on topic to market structure. So we're going to just follow this simplistic approach. Market returns to there. We are then hoping to see the market sell off. And as you see, in this instance, it didn't happen. So what we get here instead is, number one, a losing trade. So that's going to be minus 1%. When we factor that up, though, we have a minus 1% trade here. And we have a plus 3.94% trade there. So in total, over these two trades, you've made 2.94%, even though you've only won one and you've lost one, okay? 50% win rate, you're still up 3% just over two positions. Now, this is where the real beauty of trend trading kicks in. Let's think about what this has actually told us. Although we've just lost a trade, the market has broken structure. We've seen a push which has created a BOS over a previous structural high. So let's map that. We're up 2.94% so far. And what we've actually done at this point in time is reshift the structure from down to up. So if we continue this structure mapping, we've got one impulse, correction, impulse, correction, impulse, correction, impulse. Now we've had another impulse, okay? So we had some internal structure mess around, and then we had a big push to the upside, which has created an impulse. What has this impulse done? This has given us a higher high. A higher high indicates the market is likely changing direction. So what do we do from this point on? Well, first of all, that's going to be the low that we're focused on. If the market pushes under this low, that would actually shift us back into downtrend. But providing we stay above that low, we can actually now look for buying moves. So what I'm going to do here is mark out the demand zone, which is the last candle before the impulse, which has created this break of structure. So what we would now want to do is place our buy orders here, stop loss under the low, and then we could target the newly formed high, or we could extend that target even further because we now have a good idea and a good understanding that it's quite likely the market will retake this high, given that it follows the standard trend structure of, let me just map it out, low, lower low, lower high, higher high, confirming trend reversal. We're now looking for a higher low to take us into higher highs. So the no-brainer trade is the one we have mapped here. Now, let's give this a moment and see how this goes. So we see internal structure, market's not really doing too much at the moment. Then we come down into this area of demand. So the trade is then going to be triggered at this point. Now you're in a position where, number one, the market goes up and you win. Number two, the market goes down, and that's going to reshift the trend and provide you with a new opportunity to go the other way and sell, okay? So the goal with trend trading is not to be right all of the time. Nothing in trading is going to make you right all of the time. The goal here, and with pretty much every form of trading, is just to have positive risk reward and positive expectancy. Meaning we can be wrong on 50 or even 60% of trades, but the ones that win are considerably larger. So if we take a look at this, we've had a 5.42% win there at 1% risk. We have 2.94%, 5.42%. We're looking at around an 8.3-ish% return over these positions. So we have one loss, two wins. Decent win rate, but nothing crazy, 66%. And we've actually made 8.3% in just 3 positions by using this simple supply and demand method in line with market structure. So it's incredibly simple, but this is how we start to turn market structure theories into actual trades. Now, there is an extra way that you can double confirm trades if you feel a little bit nervous placing sell orders and buy orders on these supply and demand zones. This is what we call a standard confirmation entry. Now, in this market, we can see there is a clear downtrend at the moment. We created our low, lower high. Now we've pushed down with a massive impulse into a new lower low. So if this high around here breaks, that would push us back into an uptrend because that would create a impulse, which was bullish. But providing we stay underneath this high, we would be creating a lower high. Therefore, we'd have good odds to sell this market down back towards the lows, okay? So an immediate trade you could do following the method we just discussed would be a short position or a sell trade. You'd sell supply with a stop loss over the high, and your target would go down into this low. Now this, of course, is what we just discussed. This would be a fine way to approach the trade. However, psychology plays an important role in trading, and some people are going to be a bit too scared to go placing buy and sell orders on supply and demand zones like this. And sometimes you might have a couple of zones that you work with, and you're not sure which one's going to be the one that's going to create the good move. So this is where that standard confirmation comes in, okay? Now, a standard confirmation is simply a price structure reversal that happens on a smaller time frame to the one that we've prepared our idea on. And what it looks like is this that I'm drawing on the chart right now. We have an area where the market is going from higher highs and higher lows, breaks down into a lower low, and then we just simply look to use a supply zone up here to sell the market when it returns to this level. We would generally look for these patterns inside of supply and demand zones that we're interested in buying or selling from. So in a sell scenario, we have our supply zone. We know if the market gets into here, we've got good odds of selling. So we would then look for this pattern on a lower time frame once the market has hit this supply zone. And if we see that, so essentially what we're looking for is a movement like this, that's going to give us the indication and the confirmation that we need to basically double confirm the trade and give us maximum confidence on this position, which gives us the benefit of being able to execute it without worrying. And essentially then you will look to get in at this point at the top of the smaller corrective move after this lower time frame has also created a break of structure. Now this market did provide this opportunity, so let's take a look at that now. We're going to drop down to the 5 minute for this one. We are now looking for that standard confirmation that we just discussed once the market has hit this level of supply, okay? So here you can see we've had a push up, high, pull back, higher low, push up, higher high, pull back, lower low. So here we've had a break of structure on a lower time frame, okay? The break came in here when this candle closed beneath this previous higher low. So you can see that kind of, we get a trend inside of a trend, right? Although we're looking at an overall downtrend, we can see that there is kind of its own uptrend on this lower time frame. So what we're looking for is this uptrend to also shift into a downtrend, because then we have high time frame and low time frame agreement, right? When you get high time frame and low time frame agreement, you have the best odds of success in a trade. Now what we're looking for is a supply zone with imbalance. We can see here this blue candle, which is the last candle before the impulse, the last candle that goes sideways before the push down, right? Still has some imbalance in it between this wick just here, okay? So therefore, that's going to be our area of interest. We can sell there, stop above the high. Now realistically, you can put your stop loss above the swing high. If you want to be safe though, you can still keep it over the higher time frame structure. And then targets wise, we are just going to go down and target the low that we were looking at before. So if we go back up to the 10-minute time frame, you can see that we also have that confirmation here. High, higher low, higher high, lower low. Okay, we've had a break underneath. Now we'd be looking to sell upon the return to this level. So this will be a 5% return trade. If you went for the refined one, you're looking at 10% plus, which is a massive position. And here's what it looks like in the real market. So you see a drive down from that level, and slowly, surely, eventually the market gets its way down to the target. So that is how you use confirmation entries to get safer opportunities, because number one, you've got high time frame agreement, large bearish impulse, corrective move, supply zone to sell. Now number two, you've got low time frame agreement. We have the impulse on the low time frame shifting us into a bearish market. We can look for a pullback and then we can sell from there. We can target this level and we have many opportunities to take partial profits or go break even or stop trail along the way. Now we're going to talk about substructure and swing structure, because this is where a lot of different opportunities come in. So remember we discussed the impulse correction format of a market? Well, depending on what time frame we're looking at, we're going to have kind of trends inside of trends. So if your high time frame analysis and your high time frame trend is on, say, the 4-hour time frame, on the 30-minute time frame, the hourly time frame, the 15-minute time frame, the 5-minute time frame, there are going to be these smaller trends inside of trends. You're going to see smaller trends taking place as you zoom in because there are more candlesticks available. So we can section the analysis into two types. Number one is the swing structure, and that is the clear directional bias of the higher time frame that you've analyzed. So if we analyzed an uptrend on the 4-hour, the 4-hour structure is going to be the swing structure, and the uptrend that we found there is going to be, again, the swing structure. But this is where the magic happens, because inside of the corrective moves or the pullback moves that we see, we get substructure, which is kind of that internal structure that we discussed. This is going to be just the corrective pullback move. But when we look at this on a time frame lower than the one we analyzed on, so in this example, if we have a 4-hour as our swing structure, and it's an uptrend, then anything beneath the 4-hour, so perhaps a 30-minute could be our substructure. And what we're going to see on the 30-minute there is inside of the corrective moves, we're going to see smaller trends. And what we're going to see there on the 30-minute is inside of these corrective moves, we're going to see smaller downtrends, okay? Whereas these might not be so visible on the 4-hour, it might just look like a couple of candles pulling back. There's going to be actual obvious trends when we scale in, creating that trends inside of trends format that we've just discussed. Now, why is this beneficial and why am I telling you? Because this provides us with new trades. We don't just have to stay isolated to buying the higher lows, But what we can also do is look at opportunities in the corrective moves to sell down through the corrective move inside of these lower time frame downtrends. Now, there are some nuances around this, and we need to be careful that we don't try to extend markets too far. So what we're going to do is go to the real charts, and I'll show you some examples of how we can trade this substructure. Let's go now. All right, so for this example, we're going to look at XAUUSD, which is gold, and we're going to the 4 hour. We're going to do that 4 hour, 30-minute format. So we can see the structure here has just shifted from bearish with these lower lows and lower highs into bullish with this break of structure, which pushed us over the previous lower high. Okay, again, all of this down here is internal structure, so the break doesn't take place until this high goes. Now, with the market pushing into an uptrend, our obvious next move is going to be looking for a buy on this market when we pull back to an imbalanced demand zone. Imbalanced demand zone, the lowest possible one is going to be here. So we would look for a position that looks something like this, waiting for a pullback down to then buy higher. This is the swing structure, okay? The 4 hour is now officially in an uptrend. This is the first impulse we are going to be looking for on the 4 hour time frame. Correction, impulse, correction, impulse, and so on and so on and so on. However, of course, if we are expecting this market to get lower, well then isn't there opportunity for us to sell through this range? Surely there is a trade somewhere for us in there that we can take on a lower time frame. And that is what this substructure trading is all about. So if we go down to the 30-minute time frame now, what we're going to be looking for here is a shift in the 30-minute structure, because as we can see at the moment, along with the 4 hour, the 30-minute structure is also up. We're creating higher highs and higher lows continuously, and that is still pretty much exactly what we're doing right now. But if there was to be a break of structure like this, well, that would change the narrative here on this lower time frame. We would have seen a higher low break, and that would then lead us into the possibility of selling on this 30-minute trend. And there's nothing that really makes this 30-minute trend less valuable than the 4 hour, okay? So what we can do here is look for opportunity to sell the 30-minute as if it's its isolated pair. And then when we start to reach more significant swing structure areas, we should look to get out. Now, what we don't want to do is try to push a substructure trade too far. We should always understand, if we're trading this substructure format, we only want to trade it down towards previous areas of demand because we expect the market is likely to trust the 4 hour more than the 30-minute, meaning the market is more likely to go higher once again rather than turning it into a new downtrend, okay, on the higher time frame. So any substructure trades we take essentially should take place within the confines of the last swing structure move. If the swing structure move is going up, we don't want to try and trade past that low, but we just want to see if we can push this market down into an area of demand before we then start buying once again. So essentially we create what we call a sell to buy scenario. We are looking to sell here, and then we are looking to buy from there onwards, okay? But it provides us with new, fresh opportunity on kind of trends inside of trends. We have our big picture narrative. Now we can look for an opportunity inside of that. So here is a quick rundown of what this might look like in a real market. We've seen the market push down under this level. We've then seen a pullback up. We didn't get a closure, so we probably wouldn't want to immediately look for a trade just there. Although, had we got in there, that would have been a very nice place to do so. Okay, so if we'd have seen a candle closure under this low, this would have been the ideal location for us to then sell from. But what we would really want to do is see a more significant breakdown from there. We need to see closures under this level essentially to validate that we are ready to go lower. Now, yes, we did have a break here, but with substructure trades, it's always nice to see us pushing more significantly into the range so that we're not getting into positions too soon. Because, of course, what we don't want to do is dive into a sell and then just get killed by the impulse continuing. We want clear indication that the impulsive move of the market, being this move here, is over for now, and that the corrective move is beginning, okay? So, there's a couple ways we could approach this. Number one, we saw a closure under this level, so you could realistically enter there. You could put your stop losses above the next high, and you could look to take the market down towards that target, where you would then look for buys. Number two, we can wait for the formation of a new demand zone or supply zone, and then sell from there. So, we have a supply zone just here. The market went and pushed down and closed, so you could look at selling from this level, and you could look to take that down towards your target. Now this one's a little bit messy. I'd prefer to go for the first opportunity of closing under the low and then selling into it, but this one is okay as well. And as you can see, the market's then pulled back and tapped it, and now we're looking essentially for a continuation lower, which is what we want to see to provide opportunity for us to be, in this position safely. Now at this point, we'd have gotten pretty much on that first wick. The market came back, tapped entry one more time, and has now pushed down to create more significant lows. So what you could do at this point is just hold this trade out and see if this is going to be the trade that gets down towards your demand zone on a higher time frame. So this area from this high down to this low becomes your substructure area, and it provides trades, essentially trends inside of trends and trades inside of trades. You have your big picture narrative of waiting for a corrective move to then buy the impulsive move and continue the swing structure, but it actually allows you to take these smaller trades, because what we've done here is confirm change in the trend that then can be sold into to bring this market lower. So that's the general idea of how we would trade swing and substructure. And then of course, after the substructure move is completed, your buy limit on the demand zone to get you into the impulsive swing structure move is going to be triggered, leading you then back into new highs, higher prices, and another profitable trade. So as you can see, this is why we don't want to try and take substructure trades too far, because as soon as the demand zone was hit, we just created a big move to the upside. So any substructure trade we take should look to pretty much just fill some of the range. Then we want to get out and move into the overall substructure idea, because that's the one that's going to be the highest confidence and the highest probability. So there are oftentimes opportunity to do this. Not every piece of substructure is going to give you a chance to get in. I'm saying based on the price action we saw up here, there wouldn't have been much opportunity for me to sell this movement back down. But a lot of the time you are going to get opportunity to sell down with the substructure on the way into larger trades inside of the swing structure move. Okay, so you look for your short-term sells there, long-term buys there, short-term sells there, long-term buys there. All right, and as you can see, we never really want to push the market past an area of demand. You're good to just run it down to where you think it's going to buy from, and then you can buy, and you might find yourself a little sell on the way into it. If you enjoyed that video, hit the link in the description at the top. There is a free course which is going to help you to build a trading strategy. Second link goes to my academy if you really want to master this fast. And with that said, that is it for this class. So thank you.